Hello and welcome to the May 2023 issue of the Zavitz and Sykora Financial Strategies video newsletter. Thank you for tuning in and listening to our update. I'm your advisor, Greg Sykora, and here with me today is my partner and your other advisor, Mark Zavitz. Today, I'm going to quickly go over our model portfolio performance. After that, we're going to go over the three major market moving events that could have a substantial impact on your portfolio. And finally, we're going to end things on a great slide I found comparing the performance of real estate versus the stock market in Canada. So to performance, over the past month, we've seen high quality bonds in our more conservative portfolios, which is the very conservative and conservative portfolio, lose value as bond yields have pushed slightly higher on the backs of strong employment data in North America. Our model portfolios that have more stocks than bonds, which those stocks skew more towards tech and environmental tech companies, which are in our moderate and growth portfolios. The performance in those particular portfolios has been quite strong. And as you can see in the year-to-date numbers, have 5 to 6% returns. So the very conservative portfolio on a year-to-date basis, after fees, if you're a very conservative model portfolio holder, you're up around 3.5% year-to-date. If you're a conservative model portfolio holder, you're up around 4.5%. A moderate growth portfolio holder, you're up around 5.25%. And a growth portfolio holder, you're up just over 6% year-to-date. It's been a while since Mark and I have talked about market drivers, but there's quite a bit going on in the stock market right now. Over the past few months, it's been kind of boring. Stock markets have been what are known as range bound, which means they bounce in a range going up and down 5 to 10%, depending on the news. But if you are paying attention to the news that does drive the stock market, there are some big drivers coming down the pipeline, particularly the debt ceiling, which is ongoing and very real right now. There's the war in Ukraine, and there is, of course, the inflation deal that we're still dealing with. So the debt ceiling is the biggest short-term driver of performance right now, followed by the war in Ukraine, which is more of a medium-term catalyst, and inflation, I'd say, is more of a longer-term catalyst for market performance. So what's been going on with the US debt ceiling, quote unquote, crisis? Well, the crazy thing with what's going on is that there's a standoff right now between Democrats and Republicans for this debt ceiling issue, and it's clearly all political. Far-right Republicans, I think they're just simply trying to make Joe Biden's life as difficult as possible by opposing anything he does, and that's really their only agenda. They don't really seem to care about the effects of having this deal implode and what it might do to the American people. And while their point of having a higher debt limit means higher debt, which comes at the cost of future growth, deciding to take a stand against a higher debt limit, all of a sudden, it's just like hypocritical. As you can see here, they didn't impose it when Trump was in presidency. In fact, if you look at how much debt Trump took on, it was quite high. So if this debt ceiling limit doesn't pass, it means that the US government will need to almost like triage how they pay and who they pay. So basically, I think that means they're going to have to prioritize who gets paid first. So this debt not only goes into servicing interest rate obligations that the government has on its outstanding debt, but also goes towards paying the salaries of politicians and federal government workers. If I were to guess what they're going to cut out first, well, they're not going to stop paying themselves. What they're likely going to do is they're going to default on their debt, which on this scale to this level has never happened before. So this would be something brand new. Right now, President Joe Biden and the leader of the House, McCarthy, they've come up with an agreement, which is about half the battle. The other 50% of the battle is getting the bill to pass through the House and the Senate. And if this doesn't pass, I would expect, a 5, 10, 15% drop in the stock market and potentially a similar drop in bonds as yields push up. However, I'm pretty confident that this will pass. The market seems relatively confident that it will pass, albeit it might be a narrow vote. And in 2 or 3 years, we're going to be right back to having this exact same conversation again. Next slide. The next wild card, it's what's going on in the Ukraine. The problem with the war is that it looked like it could have been a quick war if, I guess, Russia won, but that doesn't appear to be what's going on. And there really doesn't appear to be an end to the war in sight. Here's a screenshot I found that was super interesting from a website that estimates the amount of losses Russian forces have sustained since they invaded Ukraine February of 2022. It would appear that a majority of the initial army and forces that were brought into Ukraine that are Russian have either been killed or been wounded. I mean, these numbers are absolutely crazy. One would think that Russia might decide to call it and end the war. Instead, the recent headline that came out was that Russia has decided to move tactical nukes to Belarus, which for all intents and purposes is not even its own country. It's probably more of like a vassal of Russia, in a sign of escalation, pulling from their Cuba Missile Crisis playbook. I mean, markets have mostly digested the news, and Russia and Ukraine on a global scale, the size of their economies are quite small. Nonetheless, if things do escalate, that could really push markets, I think, to retrace quite a bit of their gains. Likelihood we could go back to the lows we saw October or June of last year when markets were down 15 to 20%. So that would mean a 20% drop from where we are now. Just in the stock market portion of the portfolio. Again, I'd say the likelihood of this is quite low, but it's still there. On the other hand, I think when this does eventually get resolved and the war eventually ends, I don't know how it will end if Ukraine cedes some territory or something like that, but that will be a nice boon for stocks and bonds. The simple thing is that war creates inflation and uncertainty, and markets hate that. They absolutely hate that. And the third point, well, commodity prices. Commodity prices, particularly food, as you can see on this slide, are starting to come down. And so are some of the input commodity prices like oil, copper, wheat, and lumber. Most of these commodities are back down to their 2018 levels. When you look at where they were to where they are now, it's around a 30 to 40% drop. Anything over a 20% drop is considered a crash. So commodity prices spiked up, went up 30, 40, 50%, and now have crashed back down to where they were around 2018. So if prices, like I think prices and costs will eventually come down, and that'll likely happen once existing inventory, which is still based off of the higher commodity prices, get sold. So that means new prices will likely be lower. But if prices don't come down, well, it's called corporate gouging. And we've all seen what happens to Galen Weston or people like him when people think that corporate gouging is actually happening. Well, we'll actually have some statistical proof that corporate gouging is happening. I actually didn't think Loblaws and these grocery store companies were doing much corporate gouging. They were just being smart business people as their input costs were fluctuating like crazy. Mark, anything you want to add with respect to what you're seeing in inflation and how it's starting to come down?
Greg, I think just the fact that it's quite noticeable. As you said, the curve rolled over about well, if I'm looking at your graph around August, kind of peaked around August, July, August last year. So we've had some steady decreases in all components of the CPI or the inflation benchmark. As you mentioned, commodity costs have really come off, so that's gonna bode well in the future once that stuff works its way through the system. I guess not the only, but one of the concerning issues is the strength of the economy and the strength of the employment situation. Once you get embedded 4 or 5% increases in wages. And once they get embedded, they take a long time to go away. So we're hoping that's not the case, because we'd certainly like to see interest rates not go up anymore. And actually, we'd like to see them come down, in 6 or 9 months, start to certainly flatline and roll over. That would be very helpful for everybody, including the financial markets.
Yeah, financial markets will love that. Well, I got a good slide that shows exactly what happens when interest rates eventually do roll over, and Feds within North America, so American central bankers and Canadian central bankers, stop raising rates. After the last rate hike, we typically see a double-digit return in equity markets. So for our growth portfolio holders, they'll probably see a double-digit 1-year return. I mean, historically, that's what's happened, but if history repeats itself, they'll likely see a double-digit return in their portfolios. I would even say the moderate portfolio would probably see a double-digit return, 10, 11, 12%, which would be nice. And our very conservative and conservative portfolios, a high single-digit return. So I think basically we're on the cusp of our next bull cycle. I really don't know when it is, if it's going to be 2 months or 6 months from now, but we're close. We're very, very close. I mean, it could have already happened. That's the other point of the fact that we're already up a decent chunk year to date. We won't be able to tell until we're able to look back a few years historically. But yeah, I mean, better performance compared to what we've seen over the past year and a half is likely on the horizon. Lastly, as I was mentioning in our opening, I came across this interesting piece that compares the Canadian stock market, as denoted by the S&P TSX Composite Total Return Index line in blue, versus the Canadian real estate markets of the various markets of the various cities across Canada, the biggest cities in Canada. Real estate has historically averaged around a 3% return going back, several hundred years of data. But over the past 40 or so years, real estate has been going up at a clip very similar in Canada and the United States, at around a 7% annualized rate. And it's actually pushed the long-term average return over the past century or so in North America to around a 5 to 5.5% level. Well, there's an economic principle called mean reversion, which typically follows large outlier bull markets and bull cycles and high performance in certain asset classes. And my guess would be that I think we're about to experience a decade, maybe a decade or two of very low single-digit growth when it comes to housing and house price appreciation, which is ultimately just moving that 5.5 or 7% annualized return back down closer to its 3% level. I mean, prices are already down from where they were in 2022 at the height of real estate in February, March, by 10 to 15% nationally. But for stocks, I fully expect stock markets to continue to return in the ballpark of, 6 to 8% a year. Be it the Canadian market, the US markets, European markets, Asian markets, emerging markets. So, even in the biggest bull market in real estate history, which you can see here on this slide, I mean, not counting any leverage, stock markets have outperformed real estate on a non-leveraged basis. And I think this is going to grow, and this performance gap is just going to widen over the next decade or so. So with that, Mark and I, we just want to say thank you so much for tuning in and listening to our update. If you've made it this far, we certainly hope we can continue to create these updates for you. In our next update, I am putting together some pieces on how I can potentially save you around $1,000 a year after tax with only about 40 to 50 minutes of work. So it's a pretty good return on your investment if you have to only invest 50 minutes to get $1,000 back. I'll put that together in our next presentation. I look forward to presenting it to you. Thanks so much for your time, and we'll talk to you all soon.
Have a good day, everyone.